Good afternoon, myself, Professor S.S. So, I like to explain the concept of capital market line and security market line. Actually, these concepts are very confused in portfolio management. So, I like to explain the nuance between capital market line and security market line. Now, what is capital market line? Capital market line is a combination of risk-free asset and risky asset. You can see the equation is given RF plus RM minus RF divided by sigma M into sigma P. And what we are calculating? We are calculating the expected return. Now, my dear student, here RF means the risk-free rate, RM means the market return, and RF I have already told risk-free rate of return. Sigma M means the standard deviation or total risk of the market, and sigma P total risk of the portfolio. The most important thing is capital market line is that here we consider the total risk, not the systematic risk as we do in case of security market line. Here total risk and total return of portfolio are considered, not the individual risk and individual return. You can see the picture here. RF is 4%. So at zero level of risk, this x-axis is the standard deviation of the market portfolio and y-axis is the return of the portfolio. So at 0 means at O, we know that standard deviation of portfolio is 0, means risk is 0 and risk-free return is 4%. For example, it can be 7%, 8%, 3%, anything. So from 4% we are drawing the line because here risk is 0, and as the risk increases, market risk increases, market portfolio risk increases, the return also increases. Here the proposition is that higher the risk, higher the return. So basically at zero level, the defensive investor is satisfied with zero level of risk and he is satisfied with risk-free rate of return, that is 4%. Means at zero level he will get 4%, and as the return increases, so the risk also increases, and gradually this CML becomes more steeper and it increases. Basically here this thing Rm minus Rf divided by sigma m, it is nothing but the slope of the capital market line. It is also known as the Sharpe ratio. Means for additional level of return, Rm minus Rf is the additional level of return. We are taking additional level of risk. So this is the slope of the capital market line, and the intercept is 4%, means at zero level of risk with the capital market line is touching this y-axis. So at 4% return, this line starts and the risk here is 0. An efficient frontier is the combination of securities where this security will be called as efficient, and where the capital market line as per the modern portfolio theory touches the efficient for frontier, it is the optimum portfolio mix. Efficient frontier I will discuss in detail in my later videos. Now, security market line. Security market line is derived from the formula capital asset pricing model, and the formula is RF plus beta I RM minus RF. Now, the nuance, the difference between capital market line and security market line is that capital market line consider total risk and total return, and security market line represented by CAPM considered individual security and not the total risk but the systematic risk, which is known as beta. Here it is based on the proposition that because of diversification, unsystematic risk is reduced to zero, so we have only left with systematic risk, that is beta. So here also on the x-axis we measure the systematic risk, that is beta, and on the y-axis we measure the risk-free rate of return and the risky asset. So at 0, say risk-free rate is 4%, and as the beta increases, the security market line also increases. Basically, security market line gives you the estimated return, as you can see ER. And how to calculate the actual return? We can calculate the actual return by C plus PE minus PB divided by PB. C means interest, dividend, anything. P means price at the end of the year, PB price at the beginning of the year, and divided by price at the beginning of the year. So here there may be three situations. If actual return equal to expected return, the security is fairly priced. If actual return greater than expected return, security is underpriced. Because you can see the actual return is more, and they expected the security that it is giving 4%, but actually it is giving 5%. So it is performing better. So it is underpriced and it lies above the security market line. And it's a good decision, the decision, it will be a good decision to buy the security at that point. And if the actual return less than expected return, the security lie below the SMPL, below the security market line, means it is overpriced. So in that situation, it will be wise to sell the security. And the best combination is that if the portfolio lies on the security market line, because security market line shows the all the good combination of risk and return. In case of CML, if the portfolio lies on the CML, it is efficient, and if the portfolio lies below CML, it is inefficient. Logically, no portfolio can lie above CML, because it means that the market is giving, that means the return will be more than the market return. So everybody will chase that security, and gradually the return will fall and it come to the return of the CML. So that is basically the difference between security market line and capital market line. So you can also see the equation. In SML, we considered beta. Beta can be written as sigma I divided by sigma m, means security, standard deviation of the security divided by standard deviation of the market. Whereas into correlation between I and M, security and market. Whereas in capital market line, the equation can be represented like this, but here there will be no correlation. Correlation coefficient is absent in capital market line, and here we considered portfolio as a total, not on individual basis. So this is all about security market line and capital market line. If you have any comment, please feel free to write on the chat box. Thank you.